What time, Dave? What time will the market run algorithmically? For the note-taking folks, the ones that are really taking it serious, learning, macros in price action, okay? Unless we're talking about the last hour between 3 o'clock and 4 o'clock in the U.S. markets, okay? The last hour, 3 p.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. There are 4 specific macros in that 1 hour time frame. Every single macro, apart from that one, is only 10 minutes till the top of the hour to 10 minutes after the hour. There's a macro in every single hour. There is no 19 minutes after the hour macro. There's no 23 minutes after the hour. Listen, folks, I understand everybody wants to have some kind of marketing ploy, some kind of gimmick to draw attention to themselves. But if you're saying there's a macro there, you are BSing. A macro only exists 10 minutes before the top of the hour. That means, in this case, what time is this? What time is that right there? It's 7:51. Okay, that's 9 minutes before the hour of 8 o'clock in the morning. So if we take a rectangle here, and you go to 7:50 to 8:10, that is the macro. See that? What did the market do? We're bullish. Where's the buy side? Here. Because it stopped right where it did over here on the 15-minute time frame too. That's this candlestick right here. That candlestick's high on the 15-minute time frame is that individual 1-minute candle right there. See that? So what does it do? It drops down at 7:51. What is it doing? It's dropping down to take the liquidity out here on that low. To do what? To start spooling. Where? To clear the liquidity above here. Sorry, folks. You can't talk about being algorithmic if you don't know what you're talking about. Okay, you can add the word to anything you want. Algorithmic camel toe pattern, algorithmic cloudy skies, pattern, whatever. Just because you add algorithmic to the name of something doesn't make it algorithmic. Okay, the markets are doing something entirely different or decoupled from what retail is looking for. And what you want to do is, when you're tape reading, you want to spend the majority of your time focusing on what price is doing 10 minutes before the top of the hour to 10 minutes after. Okay, what happens is the price engine that is the algorithm many times will spool. Okay, during these times, and it will run to where the stops are, or it will run to where the inefficiencies are. And what do I mean by that? Inefficiencies are gaps, whether they're up closed gaps or down closed gaps. One singular candle moving in one direction, that's an inefficiency. And that's what we've been talking about and showing here. So this is the algorithmic price run. This is just the run-of-the-mill scalp. Which one would you rather be a part of? If you're trying to buy on a day like this and it's bullish and you're aiming for the levels I was outlining here when we first started our live stream, which one would you rather be a participant in? Some random price only entry versus a very specific algorithmic advantage where price will absolutely start spooling and reaching for the liquidity based on time first. Clearly, it's not even a competition here. Seriously, look at this. Boom, all the way up to the high I told you it would run when we first started streaming. Okay, so there's clearly something totally different here that puts you in a different league. You're in a totally different league of trader. Your perception about price action is light years ahead of everyone else when you think like this, because you're aligned with price. You're in alignment with what the algorithm is likely to do. You're going to read it sometimes wrong. Sometimes I do. Sometimes I get all bent out of shape and feel like I want to show off, and I do something that is a little too beyond the scope of what the structure at the time is I'm trading in. Sometimes I'll do that. But when it does this here, then we can go back into, okay, what are we looking for if we miss this move? Well, what's this low? Let me take the executions off real quick. and we'll go right into tape reading the opening range. We have a low, high, lower low. That makes this up close candle a breaker. I don't draw all this stuff on my chart, but you should, because it'll help you frame everything. And if you're back testing, this is what you want to annotate on your chart. You want to have all these types of things on your chart, because it helps you identify it and remember visually what these things look like. And the market trades down here. And also, what is it doing here as it trades down into that bullish breaker there? This is not support and resistance, because support and resistance would have been, okay, well, it went above here, so it should stop there and go higher. That's how I lost money in the 90s, because I thought it was so easy that support and resistance is going to be the, the be all end all, and it wasn't. I lost a lot of money trying to do that stuff. And it's the entire range of the up close candle. The highest up close candle is your breaker. In this case, it's not even trading down to the low, but what is it doing in addition to that? You see this? That right there is a nesting of two PD arrays. So this is an old buy side imbalance, sell side inefficiency, fair value gap that was used right here, and it went up. But did it rally above that high here since this movement here? No, it didn't. It's consolidating. So it drops back down to it here, and you're still inside that breaker. So you have to afford, if you're trading long, your stop can't be so trailed up to get stopped out prematurely. So that's all factors of how I would measure where I would move my stop. So if I was going long down in here, if I went in and bought this immediate rebalance, which is the open trading down, immediately going back to this candle's high, that is extremely strong. And I'm not making that up for the purpose of being here live, and it had already happened. Go back to where I was talking and teaching immediate rebalances. They are the bee's knees for entries.